Hello everyone, welcome to Brilliant Bankers. In today's session, we will be going through the topic external commercial borrowing. So, what is an external commercial borrowing? External commercial borrowing is a financial instrument that allows businesses and governments to raise funds from international financial markets. It represents a mechanism through which a borrower, typically a corporation or even a nation, can secure capital by issuing bonds, loans, or any other debt instruments to foreign investors or the lenders. These funds are then utilized to finance the various activities such as expanding operations, investing in infrastructure, or simply managing their financial needs of the country. External commercial borrowing serves as a vital source of capital for companies looking to leverage opportunities in the globalized world, where access to diverse funding options can make or break their growth prospects. It transcends geographical boundaries and allows entities to tap into a vast pool of international investors and lenders. This external source of funding offers several advantages, including access to lower interest rates, diversification of funding sources, and the ability to raise substantial amount of capital for ambitious projects. However, like any financial tool, the ECB comes with its set of challenges and risks. It is subject to the exchange rate fluctuations, regulatory compliances, and the potential for having the higher interest rates in the foreign market. Prudent management and a clear understanding of these risks are essential for its successful implementation. So, what is ECB? It is a commercial borrowing raised by eligible residents from entities or recognized lenders through the medium or long term foreign currency denominated debts, including the Indian rupees denominated borrowings with a minimum average maturity period of 3 years and above. The eligible resident Indian entities are also eligible to borrow for a periods of less than 3 years also, subject to some guidelines given by the RBI. ECBs can be raised under two ways. It is the automatic route or the approval route. Where the automatic route, in this case, all details will be examined by the AD category 1 banks. In the approval route, the borrowers have to take RBI approval by routing the request through the AD category 1 banks. So automatically AD category 1 banks are involved in this. ECB can be denominated in both the foreign currency or in the Indian currency, and it can be used for purchase of or investment in the bank loans, in floating or fixed rate notes, bonds, or debentures, which are other than fully and compulsorily convertible instruments. The trade credits should not be beyond 3 years, should be beyond 3 years, sorry. The foreign currency convertible bonds or the foreign currency exchangeable bonds and the financial leases can be used can be taken with the use of the external commercial borrowing. Who are the eligible borrowers in this? These eligible borrowers could be the registered corporate entities, the financial institutions, or the infrastructure companies. That is all eligible entities who are for FDI. However, the Reserve Bank of India, acting as a vigilant gatekeeper, ensures that only the deserving candidates, those with a sound financial track record and a credible business plan, are granted access to the global financial avenue. In these conditions, who are all coming in? All entities that are eligible for FDI after permission from the RBI, all entities recognized as startup by the central government as on the date of raising its ECB, all ports, trusts, Units in the special economic zones, any units that comes under the SIDB or the Exim Bank, the Export Import Bank. Registered entities engage in microfinance activities like registered not-for-profit companies, registered societies, trusts, or cooperatives, and non-government organizations are permitted only to raise INR ECBs. They can't raise any foreign currency ECBs. They can only raise INR ECBs. Now, who are all or what comes under the native list of the ECB? Every borrower must have a purpose, a reason for venturing into the realm of ECB. The end use of these borrowed funds is closely scrutinized to ensure that they are employed in activities that contribute to the economic development of the nation, but not to be used in the real estate activities, investment in capital market, in equity investment, and onward lending. But here, it can be invested in working capital purpose, general corporate purpose, or repayment of rupee loan by only the foreign equity holder. These are only permitted by the foreign equity holder, that is working capital purpose, the general corporate purpose, and repayment of rupee loan are permitted for the foreign equity holders, and onward lending is not permitted. All these comes under the negative list of the ECB. So who are all the recognized lenders? In this global financial world, there are trusted institutions that are authorized to provide funds through ECB. This could be international banks, the financial institutions, or even the foreign governments. The borrowers must ensure that they transact only with the lenders who are recognized and regulated by the appropriate authorities. In this condition, the lender must be a resident of the Financial Action Task Force or the IOSCO compliant country. What is an IOSCO? It is an International Organization of Securities Commission compliant countries. They should have a multilateral and regional financial institution where India is a member. All foreign equity holders can be a part of this. Foreign branches or subsidiaries of Indian banks are permitted as recognized lenders only for the case of foreign currency ECBs. Again, foreign branches or subsidiaries of Indian banks, subject to applicable prudential norms, can participate as arrangers or underwriters or market makers and trade for rupee denominated bonds that are issued overseas. However, underwriting by foreign branches or subsidiaries of Indian banks for issuance to Indian banks will not be allowed in any case. What is a MAMP? The minimum average maturity period. In this financial story, it is important to set a timeline for repayment. In the condition of the ECB, as it is a loan or as it is a debt, there should be a timeline for repayment of this. So the RBI mandates a minimum average maturity period, which serves as a beacon guiding borrowers through the repayment process. This period ensures the borrowed funds are not for a short term nature and that the businesses have ample time to utilize them effectively. So the minimum most period is 3 years, that is including borrowings by the startup. Manufacturing sector companies may raise the ECBs of up to US $50 million or its equivalent per financial year. In this condition, it is for an year. US dollars 50 million up to 50 million is for 1 year in the case of the manufacturing sector. If the ECB is raised from a foreign equity holder and utilized for working capital purpose or general corporate purpose or for repayment of the rupee loan raised domestically for the purpose other than the capex, that is a capital expenditure. In this condition, the MAMP will be for a period of 5 years. If the ECB is utilized in the purpose of working capital purposes or the general corporate purposes, the minimum average period is 10 years. And if it is used for the repayment of rupee loan, if it is used for the repayment of rupee loan for capital expenditure purpose, then it is for 7 years. And if it is for non-capital expenditure, in that condition, it is for 10 years. So the minimum average maturity period is 3 years. That is for including the startup case. If it is for the manufacturing sector, for an amount of up to US dollars 50 million, it is 1 year. If there is any investment by the foreign equity holder, and if his investment is for the purpose of the working capital or the corporate or the repayment of rupee loan, then it is for 5 years. Or if the ECB is raised just for investment in working capital or general corporate purpose by any companies, then it is for 10 years. Or if it is raised for repayment of a rupee loan, if it is for a capex purpose, it is 7 years. And if it is for a non-capex purpose, it is for 10 years. What is the all in all cost ceiling? What is it? All in all cost ceiling. Taking this as a picture, the ECB as a picture to safeguard this from the interest rates, a cap on the cost that the borrower must bear for availing these funds was decided. The RCB, like a vigilant person, set an all-in cost ceiling which includes the interest costs, fees, and any other expenses related to the borrowing. This ensures that the businesses don't find themselves burdened by the exorbitant costs or safeguarding their financial health. In this condition, as per the new terms, any new external commercial borrowings is being taken. The interest rate that is fixed is the benchmark rate plus 500 basic points as the spread rate. So, where from is the basic points taken? It is taken from the labor. In any existing ECBs, in that condition, it is the benchmark rate plus 550 basic points. And if it is in a INR denominated ECB, in that condition, the benchmark rate plus 450 basic points are used as a spread rate for the calculation of interest. All in cost includes the rate of interest, all other fees, expenses, charges, the guarantee fees, ECA charges, whether paid in foreign currency or INR, but will not be included in the commitment fees and withholding of the tax that is payable in the Indian national rupee or the INR. In the case of the fixed rate loans, the swap cost plus the spread rate should not be more than that of the floating rate plus the applicable spread, which should not exceed 4% of the issue size or 2% of the issue size if it is a private placement. What are the operational concepts of ECBs? The borrower is to cover the principal as well as the coupon through the financial hedges. So whenever there is a ECB that is taken, the borrower is to hedge his position starting from the time of each and every new loan or a new commercial borrowing. The ECB borrower will be required to cover principal as well as the coupon through financial hedges. The financial hedges for all exposures on the account of ECB should start from the time of each and every exposure as said earlier. All eligible borrowers can raise ECB up to a amount of US dollars 750 million per financial year through the automatic route, except for that of the startup. In case the foreign currency denominated ECB is raised from a direct foreign equity holder, the ECB liability to that of the equity ratio of the ECB should be 7 is to 1, and it should not be more than 7 is to 1. No financial institution should give a guarantee in the case of an ECB. No financial institution means no Indian banks, any financial institution or NBF relating to the ECB is permitted. ECB is meant only for exchange, foreign currency expenditure can be parked abroad. When an ECB that is being issued in a foreign currency, which is being marked for the repatriation abroad, then it can be parked abroad itself. ECB proceeds meant for rupee expenditure should be repatriated immediately. If there is any ECB proceeds that is made for rupee expenditure, it is to be repatriated immediately for credit to the lender's rupee account with the AD category 1 banks in India. As said, the borrowers can park the proceeds in term deposits for a maximum period of 1 year in an unencumbered position. Unencumbered position means there is no loan to be taken on the deposits that have been parked. Any drawdown in respect of an ECB should take place only after obtaining the LRN from the Reserve Bank on submission of Form ECB. In the borrowers are required to report actual ECB transaction in forms to RBI not later than that of the 7 days from any changes, if any. The refinancing is permitted if refinancing of existing ECB by fresh ECB is permitted, provided the outstanding maturity of the original borrowing is not reduced, and the all-in cost of the fresh ECB is lower than that of the all-in cost of the existing ECB. So, branches of Indian banks are permitted to participate in the refinancing of existing ECBs only for highly rated corporates and for the Maharatna or the Navaratna public sector undertakings. What is a Maharatna or Navaratna undertaking? Something like the BPCL. What are the reporting requirements or the reporting procedures in ECB? We'll go as per the topic. The intimation to RBI. Prior to entering into an ECB transaction, the borrower is required to submit an online application to RBI through the ECB portal maintained by the RBI. This application is essentially an intimation of the ECB transaction, and it provides details about the borrowing, such as the amount, currency, purpose, and other relevant informations. The post disbursement reporting. After the disbursement of the ECB, the borrower is required to submit periodic reports to the RBI. These reports include details like the amount of ECB availed, the purpose for which it was availed, and the information about the lender. Borrowers are required to submit a utilization certificate to the RBI through the authorized AD Category 1 bank within a period of 6 months from the date of disbursement of the ECB's proceeds. Borrowers are also required to submit an annual performance report and APR on the operation and the performance of the business to the RBI through the designated AD Category 1 bank. This report is typically required for all ECB outstandings as on March 31st of the previous financial year, and it should be submitted by the December 31st of that year. March 31st of the previous financial year, and it should be submitted by December 31st of that year. All APRs have to be submitted. Any changes in the terms and conditions of the ECB agreement shall, as the amount, maturity, or purpose, need to be reported to the RBI through the ECB portal. This includes any amendments, modifications, or the rollovers of the ECB. The borrower must report the prepayment or repayment of ECBs to the RBI through the designated AD Category 1 bank. This is crucial for maintaining accurate records of the outstanding ECBs and regularizing the delay. In the case of regularizing the delay, any borrower who is otherwise in compliance of the ECB guidelines can regularize the delay by reporting or in reporting by payment of late submission fees for a period of the delay, and the delays may be ranging up to 30 days from the due date of submission to beyond 3 years from the due date of submission. So it can be from 30 days from the due date of submission to 3 years. The late submission may also range from rupees 5,000 to rupees 1 lakh per year, depending on the extended delay as per the requirements. Whenever there is a delay in reporting, it can be regularized by paying rupees 5,000 to rupees 1 lakh per year, depending on the period of delay. So, can a EC be converted into a equity? Can the conversion be done? Yes. The activity of the borrowing company is to be covered under the automatic route of FDI. In this case, it can be done with the lender's consent. Conversion should be with the lender's consent and without any additional cost and adhering to the sectoral cap as per the FDI policy. So conversion is only done with the consent of the lender and without any additional cost. The pricing guidelines are also to be adhered. Like if the borrower has availed any credit facilities from the Indian banking system, all guidelines issued by the Department of Banking Regulations of the RBI is to be complied with, including the consent of the other lenders. So automatically, if the lender is ready to convert his ECB into equity, it can be done, and it can be done as per the pricing guidelines and also by adhering to all the guidelines of the RBI. What is foreign investment? Foreign investments are of different types. So foreign investment in India, it plays a significant role in the country's economic development and global integration. The Indian government has implemented various policies and reforms to attract the foreign capital investment. Coming to the main two types of investment, one is the FDI and the other is the FPI. FDI, which means foreign direct investment, involves a foreign entity making a substantial long-term investment in an Indian business or project, which typically grants the investor a significant degree of control or ownership in the target entity. And what are the sectors it can invest? FDI is allowed in most of the sectors, although there are certain restrictions or caps in sensitive sectors like defense, insurance, and the multi-brand retail sectors. So FDI involves in the equity instruments. It is made by a person who is resident outside India. It's made by a PROI, a person resident outside India. It's made on a repatriable basis. It's made on a repatriable basis in an unlisted Indian company. It can be up to 10% or more of the paid up equity capital on a fully diluted basis in a listed company. In an LLP towards the capital contribution in an LLP. Towards the capital contribution in an LLP. In case an existing investment by a person resident outside India in equity instruments of a listed Indian company falls to a level below 10% of the post-issue paid up equity capital on a fully diluted basis, the investment shall continue to be treated as an FDI. Once an FDI is always an FDI. Once the investment has come through the mode of an FDI, it is always to be considered an FDI, even if the investment falls below 10% of the paid up equity capital. What is a FPI? FPI is foreign portfolio investment. It involves the investments in financial assets such as stocks, bonds, or other securities of the Indian companies or the government securities. Unlike the FDI, FBI does not provide any direct control over the target entity. FPI is regulated by the SEBI, the Securities and Exchange Board of India. FPI involves the investments made by the PRIU, that is a person resident outside India, in less than 10% of the paid up capital of a company on a fully diluted basis of a listed company. 10% limit for foreign portfolio investors shall be applicable to each portfolio investor or a group that is as per or as referred in the SEBI Act or the SEBI Foreign Portfolio Investor Regulations, which was put up in 2014. ROA may hold foreign investment either as a FDI or FPI in any particular Indian company. What are the other type of investments or foreign investments? It is venture capital. Venture capital, or it can be called as a private equity. These are investments made by venture capital firms which provide capital to startups or growing companies or companies undergoing the restructuring. What impact does it do? These VC investments can have a significant impact on the innovation, job creation, and the business expansion in India. Foreign institutional investors are institutional investors like the mutual funds, pension funds, and the insurance companies that are from abroad. They invest in the Indian financial market primarily in the stocks and debt categories. And they are regulated by the SEBI. Sovereign wealth funds. Sovereign wealth funds are state owned investment funds that manage a country's reserves of surplus funds. They invest in a wide range of assets, both domestically and internationally. These funds can invest in Indian markets directly or indirectly through other investment vehicles. What is a joint venture or a collaboration? Foreign entities can form joint ventures with Indian partners to establish a new business entity which can facilitate technology transfer and the market entry. That a company from the foreign country can enter into India for extending their business. In this case, we can take the example of Hero Honda, wherein Honda came into India with their technology, had a joint venture with Hero, making it one of the world's biggest seller of motorbikes. What is a startup company? Startup company means a private company that's incorporated under the Companies Act 2013 or a registered partnership firm or an LLP that is recognized as such by the DIPP, which comes under the Ministry of Commerce and Industry, Government of India. And it complies with some conditions. The startup recognition is only for a period of 7 years initially. If it is of a biotechnology sector, then the recognition is up to 10 years. If in any case, in a financial year, they have a turnover of above 100 crores, then it is not called a startup. And the entity is working towards innovation, development, and improvement of product or process of services, or operating on a scalable business model with high potential for employment generation or wealth creation, then it is called a startup. So, who are all the eligible investors or the investees of foreign investment? That is the person who can invest and the places they can invest. That is investors and investees. So, the investors are the PROIs, those who are non resident entities, the NRIs, the overseas citizens of India, and foreign nationals. All are eligible for investing in the FDI or FPSK. They can also be venture capitalists or foreign institutional investors. All NRIs in Nepal and Bhutan, subject to the inward remittances received, is in free foreign exchange. Any OCBs, the overseas corporate body, that which does not come under the caution list of RBI, can be a investor. Foreign portfolio investors are eligible investors, and foreign venture capital investors are also investors. Who are the eligible investee entities? Where, which are the places that a investor can invest? Indian companies, as defined under the Companies Act 2013, trusts that are being venture capital funds and regulated by the SEBI, limited liability partnerships, the special investment vehicles, and the startup companies are the place where investment can be done. There are some prohibited sectors also. So, some prohibited sectors are the lottery business, that is including the government, private, and the online business, gambling and betting, which includes the casinos, chit funds, nidhi businesses, trading in the transferable development rights, real estate business, which includes the construction of farmhouse extra, manufacturing of tobacco, cigarettes, and tobacco substitutes in India, and sectors that are not open for private investment, like the atomic energy and the railways. These are all the prohibited sectors for foreign investment or foreign direct investment in India. So, with that, we sum up the session. That's it for today's session. Any doubts or queries can be updated in the comment section. I hope today's session was fruitful. Please do like, share, and subscribe our channel, Brilliant Bankers. This is Nishant signing off. Jai Hind.